Hey, what's going on, everybody? It is Aaron Trevino here, and we have a very special guest today. We have Evan Polaski, and he is an active and passive real estate investor. How you doing, Evan?
I'm doing well. How are you?
I'm doing just fine this Friday. It's a beautiful day, and it's great to have you on the show.
Yes, happy to be here.
Absolutely, Evan. So for those of us who aren't too familiar with you, would you introduce yourself, please?
Yeah, so my name's Evan Polaski. I'm based out of Cincinnati, Ohio. I'm, as Aaron mentioned, both an active and passive real estate investor, and kind of moving a little more towards the passive side with a lot of my stuff, but primarily focused on single family rentals. Still own a couple of those and have been doing that for about 10 years now. Uh, my wife and I will flip houses together, and we've been doing that for 5.5 years, and then have been actively pursuing syndications and the passive side of things for the last 1.5 to 2 years.
Okay, yeah, absolutely, Evan. I'm curious as well. You had mentioned how you were kind of leaning towards, the passive investments as opposed to active. Is there a reason for that strategy?
Yeah, it comes down to a couple things. A, as a lot of passive investors will mention, it's time. So I have a full-time job that I really enjoy, and being a landlord and finding new deals and all that stuff doesn't always align with that. Although I will say most months owning rentals is very easy. I cash a check, report it in QuickBooks, and that's it. Um, but the bigger factor, or the combination of factors, is last year on one of my single family rentals, I had to put a new roof on. Something that happens when you start owning property long enough. And that was a $6,000 bill. Okay, thankfully I had the capital to do that. But it made me think about how at some point that roof that I just spent $6,000 on is going to wear out. And so I can either hope to have the money whenever it wears out again in 25 years, or I can start reserving a little bit every month for the next 25 years. The process was that got me thinking to really just being more conservative on my budgets, and particularly CapEx, knowing that everything will wear out at some point, and starting to run the math and see how much I need to reserve to handle all of those, and looking at syndication and saying, I have a lot of, I have a lot of equity in my single family rentals. So my return on equity was very low because my cash flow, once you truly account for all the reserves, was not very high. And again, these are, just to be clear, these are properties that I bought in the financial crisis, out of foreclosure. So I'm not in these properties much at all. It's just the matter that CapEx adds up very quickly, and it tends to start hitting all around the same time. So you're going to spend a lot of money if you hold a property too long.
Yeah, absolutely, Evan. I guess like anyone else, it kind of comes down to you, your schedule and your personal strategy, because there's really no one size fits all.
That is true. And I always tell people day in and day out, my current situation has me moving towards the passive side of things. Now, my wife and I, as I mentioned, still actively do flips, typically about one a year. So it's not our full-time gig, and we still like that. I like getting my hands dirty when I choose to. She's a designer, so she likes getting to pick out all the fit and finish items. But so that we still actively pursue. But particularly on the rental side, it's just I've become more conservative with my numbers. And when I start adding up that true cash flow with very healthy reserves over my equity, on an annual basis, I started looking at syndications and said, I can make more money and not have to keep chasing down deals. They'll kind of come to me in the syndication world and the passive side, versus, active and having to, even if I sell one, I then have to actively chase down and try to find that next rental to buy to keep that money working for me.
Sure, absolutely, Evan. It's great that you have that sort of self-awareness, because, at least right now with technology, it's easy to kind of get that shiny object syndrome and just kind of chase anything that looks appealing, but you're kind of laser focused.
We all get the shiny object syndrome. So I won't say I'm immune to it, but yes, it's like I kind of alluded to. I started working commercial real estate 15 years ago, and just kind of known that that's even then, from a young age, knew that I just was always fascinated by real estate. So it's just kind of been one of those, everything sort of aligns, and I've, the path was not a straight line. It kind of zigzagged, but ultimately ended up back there, and realized that, I like investing in properties. I like investing in larger, small properties, big properties. It's just a natural fascination with real estate that I can remember from a very young age.
Sure, absolutely, Evan. I guess that kind of leads into the next question. I mean, what's special to you about real estate? From a younger age when you were growing up, was there any particular moment that really intrigued you and made you think, "Hey, this is the industry for me"?
When I look back very young, and again, I can remember growing up 6, 7, 8 years old, it was more just the something innately that was like wanting to own things. I think all little kids have like that collector kind of mentality, and I don't know that we all necessarily outgrow it more than we just repress it per se. As you can tell with rich guys who who collect cars, or any other number of collections. But it was just understanding like somebody owns that, and I want to be somebody that owns that. And that was houses, which, being 38 years old, growing up in the lifestyles of the rich and famous, and Robin Leach days, you automatically are drawn to. But I remember they were building a Publix shopping center. I was living down in suburban Atlanta, and just like being fascinated by like there's ground, and now there's going to be this like whole shopping center, and like I would love to own that, or the office building. Like there's no specific industries, particularly that young. It was just always I want to someday own stuff like that. Like that would be cool, with no financial knowledge, too young to have the financial understanding of it, but always just being fascinated by it.
Sure. No, I find that super interesting, Evan, because, it kind of seems like from a younger age, when you think of the words real estate, you think, transacting, buying or selling a house. But for you, that wasn't the case. The first thing you saw was that Publix.
That's one of my earlier memories. I'm sure there were houses involved there too. Um, but yeah, it was just any and all real estate. It was just like it was owning buildings. Like I wouldn't even say I was sophisticated enough to know it was real estate. It was just, that's cool. Like somebody owns that high rise, somebody owns that shopping center, somebody owns that mall, apartment complexes, houses. It was kind of the whole thing that just always drew my attention. And I remember being fascinated about knowing who did that. Sorry, I'm getting interrupted now.
Yeah.
I can't right now. The joys of working from home with a 3-year-old. I'm going to become one of those.
Oh, man.
Sorry about that.
Not a
You can
problem.
cut that one out or not cut it out. It doesn't matter.
Yes, sir. Not, not a problem. Not a problem. But yeah, that's interesting as well. And I'm curious, like many other people who also have full-time jobs, to me, if you have a full-time job and you're talking about investing, actively or passively, I think of, time constraints, especially if you have a family, you have a lot going on. How do you keep yourself organized?
Um, Sometimes very well and sometimes less well. uh, I'm a piler, so I kind of have my piles of things, and there's kind of like the, needs to be handled. Typically, they tend to fall into two main categories, although they always spread. But needs to be handled, or has been handled and needs to be put away, or snapped into QuickBooks. So when we're doing a flip, that's always my problem. I just get a big pile of receipts and invoices and need to sit down and start, snapping the picture with QuickBooks on my mobile app and saving it with the entry for my bookkeeping. On other stuff, it's thankfully I'm down to just a couple rentals, so there's not a lot of back and forth, and it's just generally sometimes very well, sometimes not. Just trying to knock it out as soon as it comes up. A tenant called me 2 weeks ago, and her my water heater, her water heater, sprung a leak. It's old and started rusting and needed out. So it's easy to say, okay, I'm going to get to that. Of course, a water heater is pretty important with hot water in the middle of winter. But, if you just kind of grab it and say, fine, I'm going to call my couple contractors, I'll just drop what I'm doing elsewhere. Thankfully, I have some flexibility in that regard and just knock this out now. Then I don't have to keep it on my mind as something I have to do later. Like I said, I'm guilty of procrastinating and getting behind on stuff, but I try to just, if you just address it right away, then it's off your plate. You don't have to handle it anymore.
Sure, absolutely, Evan. And I know you'd also mentioned as well that your wife is on your team too. She's a designer, right?
Mm-hmm. Yes. So she, I always joke with people that we're the traditional HGTV couple to a certain extent. I'm handy, although I've learned that I don't want to be a contractor. I like doing some construction work, getting my hands dirty when I want to. So we always approach all of our flips, or we try to approach all of our flips with, budgeting to hire everything out. And generally we're pretty successful in that. But there's always those little projects that I'll go over on the weekend. But yeah, she really enjoys the, you know, tile selection and kitchen layouts and what lights and what poles and what colors are going onto the walls. So it's worked out pretty well, and she's got a great eye for that as well.
Absolutely. That's definitely a great thing when you can work together and have your own operation.
Yes, it's the one learning lesson. What at a period we were trying to do it more full time, where I had sold a business and we were going to just keep the rentals and do some flips and take the profits from the flips to buy more rentals, but keep reinvesting the capital back into more flips. And I learned very quickly that my wife is she's a great boss, and she was when she had her corporate job pre-children. We're still friends with some of her, people that were reporting to her. But reporting to my wife was something that I had more trouble with, as she's outlining the plan and, trying to keep us on timeline. And I'm, the one there essentially acting as the contractor and, to a certain extent, not totally, but taking marching orders from her. So that's just a little bit of a role. So yes, we work very well together, and we work much better together in the kind of partners level versus she's the GC and I'm the contractor and she's overseeing my work. That just adds a whole nother layer to any relationship.
Right. Yeah, absolutely. It's interesting kind of seeing that dynamic, between you selling the business and kind of changing course to where you are now.
Yeah, no, it's been a good transition, and that happened I sold the business in August of 19. It was a fitness business. So I was investing in real estate actively myself. Kind of my timeline was I worked in commercial real estate since 2007, but in 2013 was talking to some friends about they had started a gym, and I was ready to get out of the commercial world or the corporate world and wanted to do something on my own. So they were looking to sell their gym that they had started because they didn't want to leave the corporate world. They found out. So I stepped in, bought it from them, and ran that for 6 years, again, while also actively investing myself in real estate. And kind of got sick, as you'll find a lot with people who might work in the fitness industry. It's a good career for a lot of people for a period of time. But I kind of got to the point where it just wasn't my passion, and very happy I did it. But for 6 years, after 6 years, it was kind of just, it became a grind. And thankfully was able to find a buyer for that gym and sold it back in August of 19, at which point I had the proceeds from the sale. And that's where we're going to be doing the flips full time and keep living off the rentals until January. So it was about 5 months, and we did one flip in that period. But in January, I ended up seeing an investor relations role within commercial real estate that was my first role out of college, or comparable-ish. And just as we're talking now, loved it. I loved that first role. When I owned the gym, I would talk to people about real estate, commercial, single family, fix and flips, buy your first house, rentals, doesn't matter. If they wanted to talk, if I had a captive audience to hear about real estate, we were going to be talking about real estate. So thankfully it was, kind of fell into this role, or applied for a role that I saw that I wasn't even looking for. And, and here we are, a little over a year later, and very thankful because it's been a great ride, and something I've really enjoyed doing as well.
Sure, absolutely, Evan. It's interesting how, regardless of your journey through, kind of the, owning a gym, that everything kind of came full circle for you.
Yeah, that is, I will agree. My role today is not too dissimilar from my first role out of college. And again, there was started here, ended here, but there were lots of ups and downs and all arounds in between, to get me back to this role. But it's, as I said, it's something that when I really kind of sat down and did the self-assessment and just internally think about, like, what roles out of all the span that I've had, what have I loved about each one, what have I hated about each one. And I'm not going to say I did like a pros and cons of each one and actually write it out. It was all mental. But again, I realized that through the gym, I love working with people and I love dealing with people, but I don't consider myself a salesperson. Like, I'm not, hey, you need to do this, why, and here's why it's the best thing ever. It's like, here's what, and I did this with my gym. Here's what I've got. Here's what I offer. It either works for you, it doesn't work for you. And the role that I'm in now is very comparable to that. It's informative of what the offerings are, and not, hey, you need to be in this because, and here's why. So it kind of fits very well and lets me work with people while also having some time where I can kind of, most of my time's on the phone, but I say I still have that introverted side that I just want to sit back and pigeonhole myself in an Excel spreadsheet or something where I'm not communicating with people, and it kind of gives me that good balance as well.
Sure, absolutely, Evan. We all kind of need that time to ourselves, and it's some time to recharge. You can't. It can be tough for some people to be on the go and selling all the time, right?
It's that, and I think I might be slower than some, because obviously there's some people who find that perfect niche and they recognize it, at 22 years old and just run with it. I needed to taste, I went into Baskin Robbins. I had to taste all 31 flavors to figure out what it is I like. And, you can't eat all 31 flavors in a single sitting. So it takes some time, and, but ultimately through those experiences, we're able to learn a lot. And I'd say in many ways it helps, my day job, because of all those experiences. It's easier to relate with people when you have some type of connection, and you're not going to have that type of connection if you're just like, this is all I've done and this is the only thing I know. And if you're a very one-dimensional person, that's going to be the case. Not that anybody's just a one-dimensional person, but you deal with, I deal with contractors. Sometimes I'm having to yell at them on our flips. One part of my wife and my partner is, for some reason, I get stuck with the firing contractors piece when we have to do that. Thankfully, not very much. But she's like, I can't. She's non-confrontational, which is great in many aspects of life, but it means I get dragged into those. And so, it's kind of having that broad experience to help figure out what it is I wanted to do. And I'm not going to say that, I'm not going to wake up tomorrow, because again, I try to not shy away from the shiny object syndrome, but it's taken, I'm 38 years old. It's taken me this long to kind of come back to where I was when I took the long route in college when I was 25 and coming right out of college, to realize, wait, that's what I was really enjoying doing, from day one. And it is those experiences that kind of led me back there.
Yeah, absolutely, Evan. That's always great to hear when, kind of your journey along the way, you gain that perspective, and it helps kind of, solidify, your mission right now.
Yeah, no, I'm grateful to be where I am.
Yeah, absolutely. And I'm curious as well, if you wouldn't mind sharing, maybe, how did you get into your first deal? And could you explain what that deal was like?
Yeah, so my very first personal deal was a single family rental. So working in real estate on I think by this point I'd moved, I was no longer in investor relations. I was in a finance role. So still in capital markets, but on the debt side of things. And had some coworkers at this company that I was working for who were buying, this was 2011. So we're in the financial crisis. Um, Cincinnati, where I am located, was located at the time as well, was one of the harder hit markets with the foreclosure crisis. So I had some friends that I worked with who were doing this. In fact, I was thinking, oh, I'm going to get into college rentals. You always have college students. You always have like people coming to college. I'm going to buy there. And some friends of mine were like, nope, bad decision. You want to buy in the suburbs, inner ring suburbs, but you can get these houses for dirt cheap and you rent them Section 8. And you're going to spend, in my case, I spent about $35,000 getting a house rent ready, a 3-bedroom, 1 bath. And my first house rented through Section 8 for $839 a month. Um, I have one, well, I only have 2 rentals left. One of my 2 tenants is still on Section 8. She's lived there about 4 years. I've never had horror stories with Section 8. There are reasons why I started stepping away from it, but it was never tenant based. It was the annual inspections, and those just kept costing more and more and more. But it's friends convincing me to do it and having saved up some money to buy that first one. And it ended up being a burr before burrs were even burrs. I bought it. I had to rehab it. It had no copper. The copper had been stripped out. What else did I have to do? I had to replace a few of the appliances, just clean some stuff up. So not a major renovation, but it was still, I had to replace the AC unit. It cost me about $15,000, $13,000 to $15,000 to get it rent ready when I bought it. Got the tenant in, waited my 12 months for seasoning, and it got appraised at $74,000. And I walked out of, so I bought it in cash. I walked away from that refi with $54,000 in my pocket. I admittedly say, I hope, the capitalist in me hopes that those days come back. I am where I am because of being able to buy properties that cheap. I actually still own that house in particular. But it was that I did that once, cycled it, did it again, cycled it. Thankfully, when you go commercial lending, which I know a lot of people use, owner occupant or Fannie Mae, even if it's not owner occupant lending. When you go commercial lending, my third refi with the same bank, I was able to refi all my cash out within 3 months of buying the property. The first 2, it took the full year. Like they made me wait that 12-month seasoning, but by then I had almost 2 years of experience with this bank and had been servicing my mortgages, and they were like, yep, no, as soon as you get it rented, come talk to us and we'll lend based on the appraisal. So that was one of the big lessons of why you go to the commercial side just right off the bat. It was higher interest. It's a 20-year AM versus 30-year AM, but you get a lot of flexibility in those beyond just not having it show up on your credit report. It's been, did that till I had 9 units, and then kind of lost a little motivation. So again, fell off that track. And as I grew and my family grew, it became less and less appealing to have to answer tenant calls. It's a curse of the success, because again, 4 months in a row, all I do is cash checks, which, not complaining, that is a great scenario, but it does make that month where people start calling you feel that much harder. It's kind of like coming back to work from vacation. You're like, the last period of time was so great. Now, why do you have to bother me with stuff I have to do? But it just kind of, it starts to compound, and finally it's it's, just worth starting to unload them, especially when you're in a good market that prices are very high and you can sell for a big, good amount of money.
Yeah, absolutely, Evan. It kind of sounds like a story of, just putting one foot in front of the other, and everything, like you said, just kind of compounded for you.
It is, yeah, it was good. It was a good idea at a good time. So again, I was looking at something a little bit different, similar, but a little bit different. And I had, some friends that I trusted from work who pushed me in the direction that I went, and happy I did so. And, it was work. I've always, not always, I've almost always self-managed my properties. I've almost always self-leased. So particularly in those early days where I had a more traditional W-2 job, you're younger in your career. There's a little more face time required. This obviously pre-pandemic, where you're reporting to an office every day. But my bosses wanted to see me from 8 till 5:30 every night. Um, so uh, it was looking at houses over my lunch break. Thankfully, I was only about a 10-minute drive from the neighborhoods I was interested in buying in, um, relative to my office. So I'd leave at lunch and go tour a house or two that I'd found and pick up McDonald's on my way back to work and get right back, eat in my car and get right back to work. When I was leasing, lots of meeting tenants over my lunch break. Professional job that had a little bit more flexibility. If I was gone 75 minutes, nobody was yelling at me. But it was still, lots of just the handle stuff before work, during lunch, and after work, uh, to make it successful. I remember jumping into conference rooms in the office to talk to lenders, uh, just so I could close the door since I was in a cube my desk was on a cubicle. Um, so it was definitely a hustle, but to me, it didn't feel like it was the part of my day that I enjoyed doing. And a lot of it came back to it was mine. So even though I was working in real estate for a grocery anchored shopping center owner and operator, like that was theirs. And that, like, I was a cog in a wheel, but this was like, I own that house and I'm going to pick that tenant and I'm going to figure out the financing and I'm going to go tour the next house and the next one. And, so very much, just that sense of ownership makes the additional work easier. Uh, and I got a call at 6 a.m. on a Saturday once because water was leaking. You get up, you get out of bed, and you get over there because it's your house. In this case, it's yours. You can let it keep leaking, and it's just going to be more money out of your pocket. But beyond that, it was, it's that sense of ownership that really kept me motivated to keep doing it.
Yeah, absolutely, Evan. You definitely hit the nail on the head there, kind of particularly talking about that sense of ownership, right? Knowing that, hey, that's my house, I need to take care of it, or hey, this is my job, but I'm going to do what I can, to squeeze in a few things to kind of propel myself forward.
Yeah, no, I think one of your prior guests, Travis, I think it was him, had written an article once just talking about how the wealthy have, was it 3 to 4 income streams? So like, you know, most people, and I'm not totally dissociating myself from this group, rely on their income. I've got a W-2 job and I show up every day and I do my work and I get a paycheck every other week or once a month or whatever your pay schedule is. And that is true, and that's how most of America survives. It's probably how most of the world survives. But when you look at the wealthy people, it's no single source. Like they might have a W-2 job, but they also have money coming in from these rentals, and they also have money coming in from over here, and they've got this side hustle down here, and it's so if they got rid of the W-2 job, guess what? They've got 3 other sources of income that are probably supporting their life. But I always say it's still active. I talk to a lot of people who want to buy single family rentals. And they're like, I just want that passive income. I'm like, it is passive until it's not. It is passive until you are in an airport about to leave for a vacation, and then your phone starts ringing. Oh, and you have 10 rentals because that's how much you need to create the income that you want, or 20 or 30. Your phone's gonna be ringing that many more times. It's not a passive job. Being a landlord's not. So if you're in it just to be in it for the money, that's fine. A lot of people do it. A lot of people are successful with it, but I don't think anybody is. People always think it's more passive than it is. And then I take it a step further. Even my passive investments, do they take a vast majority of my time? No. But you're vetting syndicators, assuming you're going the syndication route for these passive real estate investments. So you're vetting the syndicators. You're, analyzing and comparing multiple deals that are probably coming at you around the same time, and presumably you have a limited source of income. So you're spending time doing that. You place the money, and yes, technically you have, most syndications, you have no voting rights. So you're at the mercy of that syndicator. Hence the reason you spend all that time, vetting them in the first place. But, it's still, I still look at the financials every quarter for the syndications I'm in. I still want to understand that they're doing what they say they're going to do, because if they start deviating from that, I'll probably ask a couple questions. But also, I need to know, like, how else am I going to know that? How else am I going to know that they're not doing what they're saying they're doing? Because they're probably going to be sending me another deal in another month or two. And if they're not doing what they're saying they're going to do I really want to put more money into that group, or am I going to be vetting another round of syndicators and trying to get on more mailing lists? So again, I had a very good friend of mine who was able to retire at 44 years old. And he's not struggling in retirement. He did choose to go back to work. He started another company after a few years. But he and I were talking one day, and he's just like, it's funny how passive money is never passive. And it's, if you're too passive with your money, somebody's going to take it from you. It's financial advisors. That's, oh, I had $5 million and then my financial advisor just ran off with it. Like, because you weren't watching what they were doing. Syndicators. I've had luck with syndicators. Most syndicators are very stand-up people. But that doesn't mean I don't trust them more than I can throw them, kind of thing. So I try to stay on top of that. And you do that enough, you talk to people who have 30, 40 passive investments, and I'll bet they're not saying, oh yeah, just twiddle my thumbs all day and just wait. They're vetting. Jeremy Roll is a good example. He is a very active passive investor. He's just managing his own portfolio. He can do it from the beach. That's the nice part, but he still has to do it.
Yeah, absolutely. Like anything else, it sounds like, you just have to do your homework and make sure everything's taken into account, and, get it done.
Yeah, it's that. And like I said, I think the perception of what a passive investment is, I think the title passive investing does not totally align with the amount of work associated with being a passive investor. Right. Passive is more the, I don't have voting rights, more than it is the, and yes, I don't have to hunt for deals. Deals are brought to me, but I still have to analyze deals or syndicators or whatever else it is. So it is a bit of a disconnect that I kind of, don't, by no means am I pushing anybody out of that realm. As soon as you can get to that level, it is the level I intend on continuing moving towards. But I always like to, just like with my single family rentals, I like to keep people, how do I phrase this? I would feel guilty if somebody took my advice and I didn't present it to them with a kind of eyes wide open point of view as I see it. Single family rentals, great, got me where I am. I reserve a lot for CapEx, because a roof costs $6,000, a water heater costs $800, remodeling a kitchen costs $12,000. those all need done, even if it's a brand new house today, at some point in the future. And you can either reserve for it today in little bits, or you can wait until it's ready and try to find the money at that point. But it's going to happen, and you're going to have to spend money. And same with passive investing. You're going to have to spend some time doing it. And it's worthwhile for a lot of people. And most of the people that I talk to, it is. But it's not passive. You don't just get to sit back and watch Netflix all day and hope that everything's just going right, because that's gonna be a very quick way to start losing money if you're taking the very passive route about it.
Sure, absolutely, Evan. It's interesting how you pointed out that misconception, because when you hear the word passive, that could be synonymous with inactivity, doing nothing. You sit on your couch and watch Netflix and everything's okay, right? But it seems like that's not the case.
Correct. Well, I'm sure there are people that do it and probably have had some success doing that. I would say they are the lucky ones. But yeah, my take is I worked hard to make my money. I want to know where my money is how it's being used, to make sure that it's growing how I want to do it. I just don't want to actively be chasing new, like I don't want to be out touring new rental properties. I don't want to be out, underwriting, 100 multifamily deals just to maybe get one, like that, and traveling to these markets and doing all that. Like I don't want that level of activity, but that doesn't mean I'm not actively monitoring and vetting the deals that have been brought to me.
Sure, absolutely, Evan. You talked a bit about underwriting and vetting deals, but you also talked about vetting syndicators and kind of doing your homework on the people that are organizing these deals. When you're about to work with a syndicator, what are you looking for to vet them?
I can normally tell right off the bat when I sign up on their website. Do I get communicated with in some form or fashion? There are lots that you'll put in your inquiry information, and I'm basically telling you at that point, I have money and I'm ready to give it to somebody. Like that's the only reason I'm even on your website and spending my time. So I'm not saying it needs to be at that level, a very, I don't expect someone to pick up the phone right away and call me like, hey, I just saw that you filled out our thing and I'm happy to, talk about it. That would be great. I would, that would move you up the list right off the bat. But even having, an automated email response that gives me a chance to open that line of communication, and it puts the onus back on me to take another step, but you've at least acknowledged you received my information, and here's how here's the process to start talking more and going from there. When I do get those intro calls, I'm probably a little more gut feel than anything else. I've seen operators who have had, and again, this is from some of my past life, but operators who have had huge success that got wiped out in the financial crisis. So track record to me is important. I want some, but it's not my decision point. It's not, oh, you got XYZ off of these deals over this period of time. Because again, with particularly multifamily syndicators, there's a lot of them out there. A lot have never sold a deal, so they're all relatively new, or I shouldn't say all of them, but there's balance to that. And I also take the entrepreneurial route of, just because somebody's getting started doesn't mean they're not a good operator. They're unproven, but if I'm getting a sense that they know their stuff, they've worked in the industry a long time, they have a good head on their shoulders, then that, again, not having a track record doesn't discount them. It's kind of a balancing act. With newer people, obviously it's a deal by deal basis, and there's a reason why new operators have to do deal by deal, because it gives the investor some visibility in the deal. So then I'm looking at deals and the assumptions they're making, and I'll ask for backup if they don't automatically provide links to backup of how they're coming up with their data points, and then assessing their assumptions from there. And the biggest one that I look for particularly when it's a one-off deal, is exit. How are you exiting this? What timeline? What's the sales price? Uh, what's the cap rate? What's the price per door of that assumption? Because for most, particularly value add, where I like to spend most of my time, the exit is half, if not more, of my overall projected return. So great. You think I'm going to get a 25% IRR over 5 years, and you're going to sell an asset that you bought for $30 million for $80 million. Cool. Why? Like, is 80 million, okay, the cap rate aligns. Good. What happens if the market tanks? What happens if cap rates go up a full percent? Okay, I'm still making an 18%. Good. But has anything in that market sold for $80 million? Has anything in that market sold for $250,000 per door? Kind of looking at those assumptions and saying the income is all fine and good, and it's going to hopefully be there. I'll test those as well. But since, I think a lot of investors look at the high level numbers and don't kind of understand where these numbers are, what's feeding into these numbers. And particularly with value add, that exit is such a big piece of the overall return that I want to make sure that exit is remotely reasonable. So one thing I ask for is show me information. I know we're talking 5 years down the road, but show me comps for fully renovated properties that trade at that cap rate. Show me comps that trade for that price per door. Ideally, show me something of similar size that's selling for that price. I don't want to be the guy holding the $100 million property when everything else in that market sold for 60 at most. It's like that disconnect seems too big for me, and it seems unrealistic, regardless of the income, regardless of the cap rate. It's just like, that's a psychological number that that a buyer is gonna have to get over for me to make my money back and make most of my return.
Sure, that definitely makes a lot of sense, Evan. Again, just kind of, doing your homework, right?
It's doing your homework, and it's, again, particularly with value add, it's just knowing what's creating that return and then digging into that. Like, to me, that's just logical, but I don't know that a lot of people do that. And, again, this is where track record doesn't come into play, because once an operator has proven themselves time and time again, okay, you don't have to dig in quite as much because they've proven that they can do this. But I still like to do at least the surface level. Like I said, the exit is a big factor for me. And, it all comes down to dollars and cents. If you can't sell it, I'm stuck making 8% per year, 9%, maybe 10%, which isn't bad. But I've seen groups that still own the properties that they bought back in the 90s. And it's just like, they've never sold an asset, or they've sold so few. They're successful. Those properties have done well, but eventually it's like, get me out of this thing. Like, I want liquidity back, and I want to do something different. So I want to make sure that I can get that. And again, I opened up a can of worms with exit strategies and everything else beyond just the prices, but it all kind of feeds together.
Yeah, that definitely makes a lot of sense, Evan. So I know you've kind of talked about, your journey, I guess, growing up in the real estate industry, your first deal, vetting a syndicator. And I know you've kind of touched on, a few of your rental properties, but can you kind of explain, what you're looking for now and what you're looking for in the future?
Yeah. So again, moving more towards syndications. I view multifamily as kind of the blue chip stocks. I don't do stocks, so I don't really know what the blue chips are these days. I'm aging myself and saying that Procter & Gamble and GE are the blue chips, but I don't think that's technically true anymore. Or maybe it is, I don't know. But so I love multifamily. It's the safest. When I was working in retail, we're raising capital leading into the last financial crisis, so raising equity. And the research we were doing showed, we went back every recession. So this time period is 2008, 2009. In the early 2000s, tech bubble crash. In the early 90s, savings and loan crash. in the early 80s. I forget what crash that was, but there were recessions basically every decade. We went back and looked at historical data, and apartments always outperformed. Admittedly, at the, this was in the 2008-9 era. Self-storage and mobile home parks were not considered institutional quality asset classes. So we didn't have data on that, but we were looking at apartments, hotels, retail, and office building. Your four main categories of real estate: commercial real estate and industrial, five main categories. Apartments outperformed in every recession. I happen to work in grocery anchored shopping centers. And so those, we were able to drill into the data, magically finish second. And that's what we were selling and trying to raise capital for. But I do think logically it makes sense. Everybody needs a place to live in good economies and bad. Everybody needs something to eat for grocery anchored shopping centers in good economies or bad. And we can get into the nuance of why grocery anchored still underperform a little bit relative to apartments. But because of the retail scope and my history, I like retail. Like there's, it's visible. You drive past it every day. I went to Chipotle for lunch today. Like, as long as it's more necessity based. I've been to the mall twice in the last year, and both times were to the Apple store to get, a new set of headphones or a Genius Bar appointment. But beyond that, like, I'm not into the regional mall area, but like the unanchored strips, where you get your hair cut, where you've got a local restaurant that you're picking stuff up from, and even the grocery anchored stuff to a certain extent, just because of the protection the grocer provides to the overall property. I like those. And those are kind of the two main asset classes. I just don't know enough about industrial, even though it seems to keep doing really well. And I know multifamily, I know retail. So those are kind of the passive routes that I'm leaning towards.
Yeah, absolutely, Evan. Well, is there anything else you haven't said that you'd really just like to hit home?
I don't think so. I think the heart, well, yes. As I just said, no. Particularly for people that are just starting out, I still remember the feeling I had buying my first house, like my first rental property. I was actually super excited about my first house I was living in. But the first investment property I had, it was thankfully cheap enough that I didn't have too much hesitation. But I remember I was standing, my wife and I were out to dinner. I didn't have any kids at the time. I can tell you where, but I'm not going to. I remember it vividly is the point of when the realtor called me and said they accepted my offer. And I was terrified because immediately I thought, what did I miss? And, so particularly for viewers of yours that are just starting out, you just got to kind of swallow it and trust that instinct that made you put the offer in the first place. And obviously you can rewind that further and say, you just got to trust your instinct and say, I'm going for it. Every good entrepreneur, everybody that has started anything, has tripped up many times. And if you're too afraid of tripping up, then, to be kind of pessimistic about, just throw in your towel now and just keep working your job and putting into your 401k. Yeah. Nothing wrong with that. I'm not saying there's anything wrong with that, but if you're wanting to start something on your own, you're just going to have to swallow that fear and that analysis paralysis and everything else, and just finally say, here's 3 good deals. I'm going to throw a dart, and whichever one sticks, I'm putting an offer in and I'm going to run with it. And it's just like getting over that hurdle to start. And if it fails, hopefully it doesn't, you pick yourself back up, you take the lessons you learned, and you try not to repeat those misses. But you got to get started if you want to get anywhere. You're not gonna finish a race, let alone win a race that you don't even start running.
Yeah, absolutely, Evan. That's wonderful advice. And for those of us who are maybe listening who want to get in touch with you, maybe we're looking to maybe get together on a syndication, or just maybe we're in your market and want to get in touch. Where can we find you?
Yeah, so I point people to LinkedIn. LinkedIn.com/IN/Evan Polaski. Just search Evan Polaski. You'll see this lovely face. Or I'm also very active on Bigger Pockets. as maybe a lot of your listeners are as well. So if you don't use BiggerPockets, do. It's a great place to learn more about real estate. But again, search Evan Polaski. I'm pretty sure I'm the only person there with that name. And connect. You can connect through either of those, and we'll, once we talk a little bit, maybe I'll send you my cell phone number, my personal email address. But connect there first.
Sounds great, Evan. Well, I've learned a heck of a lot about you. Kind of your journey. Different parts of the industry that you've worked in, what you're doing now, and what you're looking to build on into the future. So it's been a pleasure having you on the show.
Yeah, no, it's great talking to you, Aaron, and hopefully I've added some value to some of your listeners' lives and help them get over a hurdle that they might be stuck on.
Absolutely, Evan. Thank you so much. We'll talk to you soon.
Thanks.